My name is Mary Pearl Opari Adu. Welcome to the Unit 4 of Corporate Financial Analysis. So, in this particular unit, we'll be dealing with corporate distress analysis and also profitability analysis. In this particular session, we are going to discuss the meaning, the causes, and indicators of corporate distress. So, by the end of the session, you should be able to explain what corporate distress means, discuss or identify the causes of corporate distress, and also identify factors that are responsible for corporate distress, and outline the various indicators of distress. I'm sure we all remember the case of DKM and Men's Gold and all the banks that were insolvent in 2017. How were we able to identify that these companies are in financial difficulty? So in this case, we'll be looking at what financial difficulties mean, and also what are some of the signs we can tell from when a company is distressed or is not doing so well. So distress simply means acute financial hardship or crisis. In this case, when we refer to corporate distress, we are referring to businesses or firms or companies that are unable to meet their debt obligations. In other words, the total value of assets of the firm are insufficient to meet the external liabilities or obligations of the firm. And that includes when firms have unfavorable liquidity positions. In other words, their current assets are not enough to meet their current liabilities. And also when they have or their companies are on the way to become insolvent or they are actually insolvent, when they are unable to meet their long-term liabilities using their long-term assets. Also, poor administrative setup and outdated production process are all situations of corporate distress. So when you realize that the company is using outdated production equipment and processes, and overall their economic condition is also it's nothing to write home about, then it's a signal that that company is actually in distress. There are a number of factors that can account or that can cause corporate distress. These factors may either be internal or external. By internal factors, I mean those factors that the company are responsible for or has control over. And the external factors would be those external situations or events or factors that the company does not really have any control over and therefore cannot control how it goes. So when it comes to the internal factors that the company or the firm can actually do something about, they include high material costs. So high material costs can also lead to increased costs that may reduce the profits of the firm. And if that continues for a long time, the profits will be reduced, there will be low retained earnings, and it will get to a point that when the company is in need, they will need to fall on their capital and their reserves, which may get deteriorated over a period of time. And that can also lead to their distress as a company. Also, poor labor productivity, poor customer services, which can also reduce sales, and also high labor turnover and lack of efficient or skilled labor or personnel are all factors that can lead to corporate distress. When it comes to those factors or external factors that the company does not really have control over, but they can cause a firm to be distressed or have or experience financial hardship, they include shortage of power. So in cases where there are energy crisis and then the company cannot really control that, or the company has no control over power, especially when it comes to electricity and all that. Also, it's unfavorable taxation policy of government can also lead to corporate distress when you have companies' income being taxed more than necessary, and that actually can cause them to be in financial hardship. Also, threats from multinational companies can cause corporate distress. And high cost of funds, when the cost of borrowing is high, leads to high cost of capital, and that can also lead firms to become distressed or experience financial difficulties. It may lead them to have liquidity issues as well as become insolvent. Also, shortage or non-availability of raw materials, which can affect production of firms and consequently their sales, are also external factors that can cause corporate distress. Now, aside the internal and external factors that can cause corporate distress, there are several areas of the businesses which can signal cases of financial hardship. So we'll discuss these indicators in the area of operating activities, financing activities, and investment activities, as well as other areas including in the books of accounts and other related situations. Now, when it comes to operating activities, I mean the core or the primary activities that the business undertakes in order to gain revenue. Now, you can indicate or you can signal corporate distress in the area of operating activities or in the area of operations when you realize there is low production capacity utilization. So, if the firm is unable to make use of its production capacity in terms of the quantity and the quality of goods they produce or sell, and also high operating costs. The firm incurs very high operating costs in terms of administrative expenses, distribute selling and distributive expenses and all that. You would realize that that could also signal corporate distress. Also, when there are delay in the payments in the wages and salaries of employees, it's an indicator that the firm is experiencing financial hardship and therefore they are unable to pay their their employees their wages and salaries. Also, when you realize that the firm is experiencing a very high rate of labor turnover, you have a lot of employees exiting the company, writing, or you have a number of employees who are resigning from the company, and therefore the rate of labor turnover is really high in that company, then it should signal that there's a problem or there's something wrong in the company. And that could be the case where the company is having financial difficulties. Also, when you realize that companies cut down drastically on their advertising expenditure, it can also signal corporate distress in the area of operating activities. Now, when it comes to the area of financing activities, the indicators of corporate distress include rapid increase in debt. When you realize that the company is borrowing a lot, or they are defaulting in the repayment of their debts, or they are borrowing in order to pay existing debts, and they have deteriorating liquidity position, as and when or in the course of the business you realize that as time goes by, the current assets of the company keeps reducing and their current liabilities keep increasing, and therefore they are unable to settle their current obligations as and when they fall due, or they fail in paying statutory liabilities, then it's also an indicator of corporate distress, especially in the area of financing activities. Now, when it comes to the books of accounts, you can easily tell when a company is experiencing financial difficulties or there are financial hardships in the company. The very first one would be delay in conducting audits. So you realize that audit is a process that gets the books or the financial accounts of the company verified and assured. It gives some sort of assurance that everything or whatever has been reported is a faithful representation of whatever has gone on, and that all the funds and resources of the company has been accounted for, that stewardship of resources by management has been duly been recognized or been well done. Now, if you realize that the company delays in conducting audit, or for some period of time the company is not auditing its financial statement or its books of accounts, then it should indicate that there's something wrong with the company financially, and then caution should be taken when dealing with those kind of companies. Also, when there are frequent changes in the accounting policies of the firm, it's also a signal of corporate distress. in the case that there might be the possibility of window dressing or trying to present their account in a way that doesn't reveal the true or the real position of the firm. Also, non-submission of financial information to bankers and finalization of accounts very long after the end of the accounting year are all indicators of corporate distress. In other areas of corporate distress other than the financing and the operating or books of account, when you realize that there's a fall in the market value of the share of assets or the very key personnel in the company or of the company are resigning, there's a high rate of labor turnover of key personnel, like very key managers, like the finance manager, their very key personnel, then it should signal that the company is experiencing distress or the company is in distress. Also, when there are frequent changes in management, it's also not a good signal and might indicate that there's financial hardship going on in the company. So in this session, we discussed the concept of distress that signals acute financial hardship or financial difficulties, or in cases where the firm or the business is having liquidity or solvency issues. We discussed the various factors that causes corporate distress, which may be internal or external, and also indicators of corporate distress in the areas of operating financing activities and also in the books of accounts and other areas of the business. Thank you.